On the final trading day of 2025, something unusual happened at the Federal Reserve. Banks borrowed $74.6 billion through the standing repo facility. That's the highest usage in the facility's history. Most people don't know what that means, but the headlines are already calling it a crisis signal. Here's what actually happened. By the end of this investigation, you will understand 5 things. First, what the standing repo facility actually is and why it exists. Second, why December 31st creates unique funding pressures that have nothing to do with crisis. Third, the specific collateral mix that tells us who was borrowing and why. Fourth, why $106 billion sitting in the reverse repo facility on the same day changes the interpretation. And fifth, whether this is a crisis signal or the new normal of post-2023 liquidity management. This is not financial advice. This is educational analysis of Federal Reserve operations and year-end balance sheet mechanics. Let's begin. The standing repo facility was created in July 2021. It's a permanent backstop. Any eligible institution can borrow cash from the Fed overnight by posting collateral. Treasuries and agency mortgage-backed securities are accepted. The rate is set at 25 basis points above the upper end of the Fed's target range. Think of it as an insurance policy. Banks pay a premium to access guaranteed liquidity when private funding markets tighten. Most of the time, usage is zero. Banks prefer to borrow from each other because it's cheaper. But when private markets get expensive or uncertain, the Fed's facility becomes attractive. The facility exists because of lessons learned from the September 2019 repo crisis. Back then, overnight funding rates spiked from 2% to 10% in a single morning. Banks refused to lend to each other due to balance sheet constraints. The Fed had to intervene with emergency operations. The standing repo facility was designed to prevent that chaos from ever happening again. On October 31st, 2025, usage hit $35 billion, according to Reuters reporting. That was a record at the time. It happened on a quarter end, a known pressure point for bank balance sheets. Analysts noted it but weren't alarmed. Quarter ends always see elevated usage. Then, on December 31st, 2025, usage spiked to $74.6 billion. This wasn't just a quarter end. This was year end, the single most important snapshot date for global banking. Every bank, every fund, every regulated institution is judged by how their balance sheet looks on this one day. The collateral mix is important. According to Reuters reporting on December 31st, 2025, the breakdown was $31.5 billion in Treasuries and $43.1 billion in agency mortgage-backed securities. That tells us the borrowers were not just commercial banks. They likely included mortgage real estate investment trusts, hedge funds with levered bond portfolios, and other shadow banking entities that hold large MBS portfolios. But here's the detail most headlines missed. On the same day, $106 billion was parked in the Fed's reverse repo facility. The reverse repo facility is the opposite. It's where money market funds and other cash-rich institutions park their excess cash with the Fed overnight. They're not borrowing, they're lending to the Fed. So on December 31st, some institutions were desperate for cash, while others were drowning in it. This is not a liquidity crisis. This is a distribution problem. Cash exists in the system. It's just in the wrong hands at the wrong time. The plumbing is clogged, not empty. Let's walk through the mechanics of year-end balance sheet management step by step. Banks are regulated entities. They must report their balance sheet size and composition on specific dates. December 31st is the most important date because it determines their capital requirements, their leverage ratios, and their regulatory standing for the entire next year. Here's the incentive structure. If a bank's balance sheet is larger on December 31st, they face higher capital requirements. They have to hold more equity. They have to pay more in regulatory fees. The Federal Deposit Insurance Corporation charges premiums based on year-end balance sheet size. The supplementary leverage ratio is calculated using year-end snapshots. So in the weeks leading up to year-end, banks engage in what's called window dressing. They shrink their balance sheets temporarily. This is legal. This is standard practice. But it creates artificial scarcity in funding markets. How do they shrink? They reduce their lending. They pull back from the repo market. They refuse to roll over short-term loans. They tell their counterparties, sorry, we're cleaning up the books for year-end. Come back in January. This is not because they're insolvent. It's not because they lack liquidity. It's because the regulatory snapshot creates a perverse incentive to appear smaller than they actually are. A bank with a $500 billion balance sheet might temporarily shrink to $480 billion for the December 31st photo, then expand back to $500 billion on January 2nd. Now imagine you're a mortgage rat. You hold $10 billion in agency MBS. These are Fannie Mae and Freddie Mac securities, backed by the U.S. government. They're considered safe. You finance this portfolio by borrowing cash overnight in the repo market. Every day, you post your MBS as collateral and borrow cash to fund your position. Then, you roll the loan the next day. This is called matched book financing. It's standard for the industry. Your business model depends on continuous access to overnight funding. But on December 30th, your usual lenders, JP Morgan, Bank of America, Citi, tell you they're not rolling your loan. They're pulling back to clean up their balance sheets for the year-end snapshot. You still own the MBS, you still need cash, your positions haven't changed, but your funding source just vanished. Where do you go? You can't go to other banks because they're all doing the same thing. You can't go to money market funds because they're conservative and prefer parking cash at the Fed. You have one option left. You go to the Fed, you post your $43.1 billion in MBS collateral at the standing repo facility, and you borrow cash at the penalty rate. You pay more than you would in the private market, but you have no choice. It's year-end. The private market has disappeared. This is the mechanism. The standing repo facility absorbs $74.6 billion in demand that the private market refused to service because of regulatory snapshot dynamics. Now let's talk about the Treasuries. $31.5 billion in Treasuries were posted as collateral. This is interesting because Treasuries are the most liquid asset in the world. If you hold Treasuries, you should be able to borrow against them easily in the private market. The Treasury repo market is the deepest funding market on Earth. It trades $4 trillion per day. So why did $31.5 billion in Treasury collateral end up at the Fed? Two possible explanations. First, some banks may have been managing their supplementary leverage ratio. This is a regulation introduced after the 2008 crisis that treats all assets equally regardless of risk. A Treasury bond counts the same as a risky corporate loan. Both add to your balance sheet. Both increase your required capital. This creates a bizarre situation where banks avoid lending against safe Treasuries on snapshot dates because it makes their leverage ratio look worse. It's a regulatory design flaw that penalizes safe activity. Second, some foreign banks operating in the U.S. may have faced dollar funding pressures. They hold Treasuries, but need dollars to settle year-end transactions. The private dollar funding market tightened significantly at year-end, especially for non-U.S. institutions. European and Asian banks often faced dollar shortages during these pressure points. The standing repo facility became the release valve. It provided dollars when private lenders stepped back. But here's the critical point. This facility is working as intended. It's doing exactly what it was designed to do. The Fed created this tool after the September 2019 repo crisis, when overnight rates spiked to 10% because banks wouldn't lend to each other. The standing repo facility is supposed to prevent that from happening again. So when you see $74.6 billion in usage, you're not seeing a crisis. You're seeing a policy tool functioning correctly. You're seeing the fire extinguisher being used, not the building burning down. The alternative scenario, if the standing repo facility didn't exist, would be a funding panic. Overnight rates would spike. Institutions would be forced to liquidate positions at fire sale prices. The stress would cascade through the system. That's what happened in September 2019. That's what the facility was built to prevent. Let's trace what happens when the standing repo facility is used at this scale. At the top layer, the Fed's balance sheet expands. When the Fed lends $74.6 billion through the standing repo facility, it creates reserves. The borrowers receive cash. The Fed receives collateral. This shows up as an asset on the Fed's balance sheet. This is a temporary expansion. The loans are overnight. By January 2nd, most of this will reverse. Next layer down, the borrowers stabilize their positions. The mortgage rates that couldn't roll their funding in the private market now have cash. They can meet their obligations. They can avoid forced liquidations. They survive year-end without having to dump their MBS holdings into a thin market. Next layer, the private repo market. Because the standing repo facility absorbed the stress, private repo rates stayed relatively stable. There was no spike to 10% like in September 2019. The secured overnight financing rate, the SOFR benchmark, moved only a few basis points. The system stayed calm. But there's a second-order effect. The fact that $74.6 billion needed to use the facility tells us something about the state of private market liquidity. It tells us that banks are still aggressively managing their balance sheets around snapshot dates. The Basel III regulations that created these incentives are still binding. The reforms implemented after 2008 are still shaping behavior in 2025. This creates a predictable pattern. On normal days, standing repo usage is near zero. On month ends, it spikes moderately. On quarter ends, it spikes significantly. On year end, it spikes to record levels. This is now visible in the data. You can chart it, you can predict it. This is the new normal. As long as regulations incentivize balance sheet shrinkage on specific dates, the standing repo facility will absorb the overflow. It's become a scheduled event, not an emergency. Now let's talk about the reverse repo facility. On the same day, $106 billion was parked there according to Reuters. This is money market funds and other cash-rich entities parking excess cash with the Fed. These are institutions with too much cash and nowhere to invest it safely. Why don't they lend this cash to the institutions that need it? Why doesn't the $196 billion in the reverse repo facility flow to the borrowers using the standing repo facility? They're both at the Fed. Why can't they meet in the middle? Because of regulation and risk appetite. Money market funds are required to maintain extreme liquidity. They're governed by SEC Rule 2A7, which limits their ability to take credit risk. They prefer the safety of the Fed's reverse repo facility over lending to private counterparties, especially on year-end when counterparty risk perception increases. Even though the private borrowers are posting safe collateral like Treasuries and agency MBS, money market funds can't or won't step in. The regulatory framework keeps them siloed. This creates the paradox. The system has $106 billion in excess cash sitting idle at the Fed, while simultaneously borrowing $74.6 billion from the Fed. The cash exists. It's just trapped in regulatory silos. The distribution mechanism is broken. Some analysts interpret this as a sign of financial fragmentation. They argue that the traditional money markets are broken, and the Fed is now the central node for all liquidity distribution. The Fed has become the middleman for the entire funding system. Others argue this is simply the efficient outcome of a well-designed safety net. The Fed provides certainty. Private markets involve negotiation and risk assessment. When time is short and stakes are high, institutions prefer the guaranteed option. Both interpretations have merit. The system is more fragmented than it was before 2008. Regulations have created walls between different types of institutions. But it's also more stable. The standing repo facility prevents the kind of acute funding crises that used to cascade through the system. Let's address the elephant in the room. Is this a bailout? That word gets thrown around every time the Fed lends money. But a bailout implies insolvency. A bailout implies that an institution cannot repay. The standing repo facility is an overnight loan. It's fully collateralized. The borrowers post Treasuries and MBS worth more than the cash they receive. They repay the loan the next day plus interest. This is not a bailout. This is a repo. It's a secured loan. Banks have been doing repos with each other for 100 years. The only difference is the Fed is now the lender because private lenders stepped back. The more interesting question is why private lenders stepped back. Is it purely regulatory, or is there underlying credit concern? The collateral mix suggests it's regulatory. If there were credit concerns, we would expect to see wider spreads on MBS or Treasuries. We don't. The collateral is trading normally. Agency MBS spreads did not blow out. Treasury yields were stable. So the current interpretation is that this is a mechanical phenomenon driven by year-end balance sheet optics, not by fundamental stress. The system is not broken. The calendar is just causing predictable friction. Let's translate this mechanism into everyday impact. For the average person, this has no immediate effect. Your checking account didn't change. Your mortgage rate didn't spike. The ATM still works. The credit card still swipes. The plumbing of the financial system experienced a pressure surge, but the pipes held. You didn't feel it because the Fed's facility absorbed the shock. For investors, the standing repo facility usage is a signal about liquidity conditions. High usage suggests that private funding markets are tight. This can impact short-term interest rates, Treasury yields, and the availability of credit. But as long as the Fed's facility is functioning, systemic risk is contained. The market stayed calm because participants knew the backstop was there. For banks and financial institutions, this is a reminder that regulatory snapshot dates create artificial constraints. It highlights the ongoing tension between microprudential regulation, which aims to make individual banks safer, and macroprudential outcomes, which can create system-wide funding stress. Banks are individually rational, but collectively create scarcity. For the Federal Reserve, this validates the decision to create the standing repo facility. It's working as intended. The facility absorbed year-end stress without drama. There were no headlines about 10% overnight rates, no emergency board meetings, no panic. The system stayed calm. But there's a deeper question. If the standing repo facility becomes the dominant source of funding on key dates, does that create moral hazard? Do banks and shadow banks become complacent, knowing the Fed will always provide liquidity? Or is this simply the cost of a stable system? The Fed's position is that a functioning backstop prevents panics. The facility is priced at a penalty rate, so institutions only use it when they must. This preserves market discipline while preventing crisis. It's the lender of last resort at a price that encourages private solutions first. Critics argue that the Fed is subsidizing poor risk management. If institutions know they can always borrow from the Fed, they may take on more leverage than they otherwise would. They may rely on year-end Fed liquidity instead of maintaining private relationships. This debate is ongoing and unresolved. For now, the system is stable. The standing repo facility provided $74.6 billion in funding on December 31st, 2025. The loans will be repaid on January 2nd, 2026. The collateral is sound. Year-end passed without incident. But the record usage is a data point. It tells us that regulatory pressures are intensifying, not easing. It tells us that the private repo market is less elastic than it used to be. Banks are less willing to intermediate. They're more cautious about balance sheet expansion, even temporarily. And it tells us that the Fed is now the central liquidity provider, not just in crisis, but on routine snapshot dates. This is the new liquidity regime. The Fed is no longer just the lender of last resort. It's the lender of first resort on specific dates when regulations create artificial scarcity. The $74.6 billion repo surge was not a crisis. It was year-end mechanics, playing out exactly as the Fed designed. Private lenders stepped back to manage their balance sheets. Borrowers turned to the standing repo facility. The system stayed calm. This is the new normal. As long as regulations incentivize snapshot date behavior, the Fed will absorb the overflow. The question is whether this arrangement is sustainable or whether it creates hidden risks that will surface later. Watch for 3 signals in January. First, does standing repo usage return to near zero after year-end? Second, do private repo spreads normalize? Third, does the Fed adjust the pricing or terms of the facility based on this record usage? If all 3 lights turn green, this was a mechanical event with no lasting impact. If red flags appear, we'll investigate further. Next episode, the Basel III. Endgame and why bank balance sheets might shrink permanently in 2026. Subscribe to follow the liquidity trail.